welcome to another video. In this video, we are going to look at HKAS 23, which is on borrowing cost. The standard is pretty simple. And if you try to find out the HKICPA standard online, doesn't have many pages. So it's relatively simple. But then again, this video is a summarized version and just for a quick revision. So you must study, proper notes or the learning pack that you have. So let's look at what we are going to look in the video. So we will briefly see what borrowing costs are. We will define what borrowing costs are, and then what is a qualifying asset, when to recognize the borrowing cost, and when do you stop. Types of borrowing. There are two types of borrowing that we will look at, and how borrowing costs are calculated, mainly speaking. And then at the last, we will see what are the disclosures that financial statements will be required. So let's look at the first two questions, which is what are borrowing costs and what is a qualifying asset. So borrowing cost, if you look at borrowing cost just in general, right? Just in general, it's very intuitive. It tells you what borrowing costs are. Borrowing cost is any cost that you incur on a borrowing. And what is a borrowing? When you take out a loan, when a company takes out a loan from someone. So basically, if you put it in financial or accounting terms, it is an interest, because terms are important. So when we are doing accounting exams or professional exams, using these terms is very important. Whereas understanding the concept in your own words always helps, because then you have a firm base or the firm grasp over the concept, which is equally important. So basically in accounting terms, borrowing cost is an interest, and other costs that an entity incurs in connection with the borrowing of funds, right? So this is the proper definition, let's say, proper definition. Then you have a qualifying asset. So borrowing cost must be on a qualifying asset. If you know the standard, so borrowing cost has to be on the qualifying asset, right? The asset has to be qualifying. So a qualifying asset is an asset that necessarily takes a substantial period for time to get ready for its intended use. Now, this substantial period is not defined in standard. It's not defined in the standard. This substantial period, let's say, should be more than 1 year at least, I would say, from professional, let's say they call it professional judgment. So based on this judgment, or if you look at the past papers, the substantial period, I would say, should be greater than 1 year at least. Examples of qualifying assets would be inventory, manufacturing plant, and investment properties. It could be others as well, as long as the asset takes a substantial period of time to get ready for its intended use or sale, would be a qualifying asset. And the borrowing cost on qualifying asset can be capitalized. So this is the part that I briefly mentioned at the end of the previous slide. So when to recognize the borrowing cost, its commencement, and when to stop. So an entity shall capitalize borrowing costs which are directly attributable. So this is also a term used in HKAS 16. So you see they're kind of related. So I'm trying to form a connection in here as well, right? So the cost is directly attributable to the acquisition, construction, or the production of a qualifying asset, as we saw the definition of qualifying asset in the previous slide, will be regarded as the cost of asset. So it will be capitalized. So basically, the interest expense on qualifying asset would be capitalized, would be added to the assets cost. That's what it is saying. So basically, the company will capitalize the interest expense on the qualifying asset. So the commencement of the capitalization will start when all these three conditions are met. All these three conditions. So first meet all of the following conditions. So this is the key word here, right? So it incurs the expenditure for the asset. So the company must incur expenditure on the asset. It also incurs the borrowing costs. So there must be interest expense on that. And then it undertakes activities that are necessary to prepare the asset for its intended use, right? So all these three conditions must be met in order to start recognizing the borrowing cost. And then entity shall suspend. So suspension basically means temporary. It's temporary. This is temporary. So temporary stop, basically. Suspension means temporary stop of capitalization on interest expense during the extended periods in which your active development is not done. Then an entity shall cease. So basically stop. So here you have to stop. The company has to stop capitalizing the borrowing cost when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete. So basically your asset is ready, right? So when your asset is ready or is almost ready, then company will have to stop capitalizing their interest expense on the qualifying asset. No longer company can add that interest expense to the cost of the asset. So let's look into what are the types of borrowings. There are two types of borrowings, mainly specific borrowing and general borrowing. So in specific borrowings, it's basically, as you can see here, they are borrowed specifically for the purpose of building or obtaining that qualifying asset, right? Whereas general borrowing are just general loans for several or various purposes. So not really specifically for qualifying asset. Therefore, if you look at it in proper accounting terms here, it's difficult to build a direct relationship between particular borrowing and a qualifying asset. So it's hard to build a direct relationship between particular borrowing and the qualifying asset, because as I said, those general borrowings could be for several purposes. This is an example here. Let's look at an example on how to calculate borrowing cost. So one more thing that I would like to highlight in this previous slide before moving on to example is any investment income on spare funds is deducted from the borrowing cost. This is really important, and also tested in QP exams. So you have to be really careful. So if a company is investing somewhere and earning the borrowed money, earning interest on that borrowed money, so interest income would be deducted from the interest expense, the total interest expense. So let's look at an example here. So on March 1st, 2001, entity A begins the construction of a property. So basically, you can say this is a qualifying asset actually, because construction will take significant time. Entity A incurs the following expenditure on this property during the year 2001. So we are given the expense here. The expense here on 1st January 2001, entity A had 500,000 of general borrowings, which increased by 1.5 to 1.5 million in total on 1st June 2001. So on 1st Jan, company had, let's say 0.5 million. And then by 1st June, company had 1.5 million in its total borrowing, Interest expense on these borrowings calculated under HKFRS 9, so this is another standard, amounted to 50,000 for full year of 2001. So this is total interest expense on the borrowing, right? So 50,000 is the total interest expense on the borrowing. So let's look at a typed solution since my writing isn't that good. So we will look at the typed solution here. So the first thing that you do is to calculate the capitalization rate, or also known as weighted average rate. In addition to that, the example is actually about general borrowing, not specific borrowing. So as I said, as you see, specific borrowing is when you can have a direct relationship. The fund is specifically borrowed for constructing the qualifying asset or building the qualifying asset, right? Whereas in the example that we are looking at right now is a general borrowing example. So let's look at the first. So let's look at this example. The first thing that you will do is to calculate the weighted average rate, or the capitalization rate, right? So how do you calculate the capitalization rate? You take the amount, the interest expense, the total interest expense that was given to us, which is 50,000. You divide it by the loan holding, by the borrowing holding. So we had 500,000. The company had 500,000 for half of the year, and then 1.5 million for another half. So this was for half, and then this was another half of the year, which gives you an interest rate, or the weighted average rate, of 5%. So this holding was at 1st June, and this was at 1st Jan. If you just look at my previous slide, if you go back in the video, you will see that. So you would take into account the time component as well. Timing is really important in financial accounting exams or financial reporting exams. So you will calculate this weighted average rate, and then using this weighted average rate, you will apply this rate on the expenditures that were incurred. So these expenditures. So these expenditures, if we go back, here are these expenditures, and of course you will take the time into account. So let's say this was for 10 months, this one was for 6 months, and then this one was for remaining 3 months. So if you look at this here, you have this time component 10 and 7, sorry, 7, since it's 1st June, so this has to be 7. So you have 7 months here, and then 3 months here, right? So you will take into account the time factor, the expenditures, and then multiply it by the weighted average rate. You multiply it by the weighted average rate, or the capitalization rate, to calculate the borrowing cost. So these are the borrowing cost to be capitalized in the cost of asset. So you will capitalize 20,000. The company will capitalize. Entity A will capitalize $20,417. So for disclosures, it's very simple. The company will, or the entity will, disclose the amount of borrowing cost capitalized during the period, plus the capitalization rate, or the weighted average rate, to determine the amount of borrowing cost eligible for capitalization. So these two things would be disclosed in the financial statements of the company. Thank you very much for watching this video. I hope this video was helpful in your preparation. If this video was helpful, please give it a thumbs up and subscribe to my channel for more videos like these. Thank you very much.